This is the Investor Connect podcast program. I'm Hall T. Martin. I'm the host of this show in which we interview angel investors, venture capital, family offices, private equity, and many other investors for early stage and growth companies. I hope you enjoy this episode. Well, hello, this is Hall Martin with Investor Connect. Today we're here with Tom Wallace, managing partner at Florida Funders. Florida Funders is a hybrid between a venture capital fund and an angel investor network that discovers, funds, and builds early-stage technology companies in Florida. They exist to evolve Florida from the Sunshine State to the startup state by ensuring there is as little friction as possible in the ecosystem, that investors have access to meaningful deal flow and entrepreneurs have access to a wide range of accredited investors. Florida Funders educates and ignites its community of investors and network of partners to drive investment in the most exciting startups Florida has to offer. Their one-of-a-kind angel investor network provides transparency, fosters communication, and empowers strategic relationships between the investor network and the founders. Their team is composed of serial entrepreneurs, venture capitalists, and experienced angel investors, singularly focused on uncovering Florida's next breakout technology company. To learn more, visit Florida Funders. Tom, thank you for joining us.
Oh, thank you for having me on your show. I'm delighted to be here.
Great. So what was your background before investing in early stage companies?
I pretty much have been a technology entrepreneur my entire career. I got out of college in the early 80s in the dawning of the micro or personal computer revolution. And at the age of 23, with being about as green as you can be and not knowing anything about anything, my best friend and I started a company in the PC industry. And so we built that company for 7 or 8 years and then had our first exit. And then but one company pretty much every decade we've built and exited since then. But along the way, which happens with a lot of technology entrepreneurs, I ran into other entrepreneurs that, was trying to help out and started writing some checks. And so I've really been angel investing for the better part of 3 decades and had a lot of fun with it. I learned the hard way that there is a bit of a science to it, not just an art. And if you do it right, it can be very lucrative and rewarding. And if you do it wrong, it can be very expensive.
Absolutely. So what excites you right now?
Oh my gosh. Oh, there is so much out there. I mean, from a technology, this coming out of COVID, and you look at, there are so many opportunities. The COVID has accelerated so much of everything moving online. People are using Instacart and Uber Eats and stuff. It's such a rapid pace. People that normally may have taken 2 to 3 years to get there have gotten there. So e-commerce is of great interest to us. Anything that helps everybody else compete against Amazon. So anybody that has a solution that helps brick and mortar companies compete against Amazon, the e-commerce world, we love that space. We love ed tech. Cybersecurity continues to be an area that we just think there's a very, very bright future for. And we also like fintech and digital health. Being here in Florida, and I know you're in Texas, I mean, healthcare is the first or second largest part of our GDP and is only growing and too rapidly and too much inflation. And the only way we're going to really make dents in that and really move the needle, in my opinion, with healthcare, or the best way we're going to do it is through technology and the application of technology.
Well, great. Well, you're an experienced angel investor. What's your advice for people investing in startups? What do you tell them to do before they write that first check?
We call it the 5 Ds of angel investing. So first of all, diversification. The second D is deal flow. The third D is due diligence. Fourth is domain expertise. And the fifth one's diligence. And I can cover everyone very briefly. So diversification, one of the big mistakes people make in angel investing, and I made it myself, is you can't go out and do 2 or 3 deals. Or you can, but your chances of being successful are about the same as going to a casino. I mean, you need to build a portfolio. We say at least 10 companies. So early stage tech investing, as I think it's a risk reward game. So the probabilities of success are low, but when you are successful, the returns are very high. So if it's 1 in 10 deals, 2 in 10 deals, they're going to be 10x plus deals. If you're only doing 2 or 3, you greatly limit your chances of success. Second thing, deal flow. How many deals do you look at for every deal you do? I use my brother as an example of this because early on, my brother's like, Tom, I'm not doing any more of that angel investing. I did 3 deals. They all went to 0. I'm like, well, Tim, that's my older brother's name. I said, Tim, how many deals did you look at to do the 3 deals? He said, well, 3. And I'm like, well, that's part of the problem. So in our business here at Florida Funders, we look at roughly 40 to 50 companies for every one we end up selecting and investing in. And then due diligence, there's a lot of research on this. If you do 20 plus hours of due diligence, any angel investment, early stage tech investment, you significantly increase your probability of returns. At Florida Funders, we do 70, 80, 90 hours of due diligence on every company before we invest in them. And then domain expertise, invest in what you know. If you're a doctor, obviously you're going to be a lot better at investing in medical devices than I am. I'm a software content guy, so in infrastructure. So between me and my partners, we try to stick with what we know. And that's mostly SaaS software, infrastructure, content, plays like that. And then the last one, you got to be disciplined. So with all these 4Ds, you got to do them over and over again, consistently and consistently. So that's very quickly what we've learned in the years, and has helped us become, we think, pretty good at investing.
And so on the other side of that table, what's your advice for people running startups? What do you tell them to do before they go out to raise funding?
Well, I've been on the other side of it. And, I think that what we look for in founders is we look for a lot of this, especially the earlier stage you're investing in, especially if you're doing pre-revenue deals, which we don't do a lot of here at Florida Funders. Most of our companies are what we say, they sit between family and friends and Series A. Our average check size is about $1 million. So most of our companies have at least a minimal viable product. They have some customers or some pilots. They have some amount of traction. But the earlier the stage, the more important we believe you're betting on the founder or founders. So first thing we want to see in a founder, we want to see, do they have the right stuff? I'm sure building companies is really hard work. And it's never linear. When Uber almost went out of business 3 times, do they have what it takes? It's going to get really tough. They're going to get punched in the face. They're going to get knocked down. Are they going to persevere? Are they going to do whatever it takes morally, of course, to be successful? So that's what we're looking for founders. And I tell founders it's a decade commitment. If you're going to do this, you're going to be signed up for a decade and you're going to be all in. I mean, working your tail off. This is not a 40-hour week. We don't want to hear about work-life balance. You're going to work your butt off. You're going to work weekends. You're going to work late nights, and you're going to really put everything you have in this. And as an investor, we want to see that our founders are that committed. The second thing, I tell founders is, and the biggest mistake we see with a lot of young entrepreneurs, and I know because I used to make all these mistakes myself, is focus. Really, don't try to do 5 things. Don't try to do 4 things. Don't try to do 3 things. Try to really focus on one thing and do it really, really well and get your team super focused on that. And then team is the third thing. I mean, business is a team sport, as Stephen Jobs said. You're only as good as your team. Surround yourself with people that are smarter than yourself. You got to be really good at sharing your vision, getting people excited about that vision, and recruiting people that are going to make less money than they were probably making wherever that you get them from. And they're coming for equity, and they're coming because they buy into the vision, and they're coming because they believe that you're building the next unicorn.
Well, that's great advice. So let's talk about the state of angel investing today. How do you see the industry evolving? Where do you see it going?
I think it's a great time to be an angel investor, like no other time, because if you look at what's happened in venture capital, and angel investing and venture capital are pretty closely tied together, is most of the big venture capital funds have moved upstream. They're raising billions and billions of dollars. They're not writing $1 million checks. They're writing $10, $20, $30 million checks. Andreessen Horowitz has kind of led the way with this. They're even doing later stage deals where they're given, and companies are waiting so long to go public. Look at Airbnb. Look at these companies worth $30, $40 billion before they go public. So that's where a lot of the Silicon Valley money is moved to. So there's a really nice niche for angel investing when companies only need to raise $500,000 or $1 million or maybe $2 million. And angel investors can get in really early and before the valuations are high. Again, they have to do all the 5 Ds because they have all those challenges. But I really believe that this is one of the best times to be an angel investor that have ever existed. And then on top of that, if you look at what's coming on from a technology standpoint, I mentioned I got out of college in the 80s, and the personal computer changed everything. Up until then, only universities and large corporations could afford computers. With the advent of the personal computer and IBM in 81 coming out with their PC, Now, every small business could afford a personal computer, every home, and you didn't have to be a geek to program it. There was software available. That created a revolution that happens about every 10 to 15 years in the industry. Happened again in the internet with the internet in 95. Happened again in 2006 with the smartphone and the cloud. And if you think about where we're at now, I mean, we've got artificial intelligence, augmented virtual reality, blockchain, 5G, quantum computing, autonomous vehicles, all these game-changing technologies hitting us at one time. So from an investor standpoint and a founder standpoint, the wealth creation opportunity and the investment opportunity the next 5 years presents is just, I think, unprecedented and incredible.
Great. And so what do you think is the biggest change we'll see in the next few years?
The biggest change? Wow, that's a tough one. I think there's so much capital out there. I've always believed that the great technology and innovation comes from small companies. The big companies, the Googles, the Apples, the Facebook, the FANGs, they're not going to be the innovators. But I think what they're doing, and we're seeing this, is they're going to be acquiring technologies earlier on. So you saw this with Facebook, with Oculus, and you saw it with Instagram, where they acquired those companies when they were pretty young. And I think that trend is going to continue because they have to be innovative. And these companies are so powerful, they're sitting on so much cash. And it's very difficult for those companies to innovate. So it's good for investors and it's good for founders because the exit opportunities are going to be plentiful if you have a great product and a great market and are really crushing it.
Great. So what's your investment thesis for startup funding? What do you look for?
Well, again, the stage we look for is we call early stage. As I mentioned, that between the family and friends and Series A, we look for really, really good founders and the team. We looked at their solving a problem, a real problem. That their solution is we interview those early customers, that it's not a nice to have, or it's kind of cool. What we want to hear, we love this product. We don't know what we'd do without it. We ask a lot of detailed questions, and we want to know that this solution is really different than anything else. It doesn't mean they don't have competition. In fact, if they don't have competition, sometimes that's a little concerning, but they are clearly different and have something that's unique. And their secret sauce is something that is not easy to replicate, that their chances of success are going to be increased because somebody's just not going to be able to come along and knock them off. And this isn't easy to do. And if they're solving a big problem and they have that unique selling proposition, tremendous value add for the customer, and then they're in one of the spaces that we like cybersecurity, like fintech, ed tech, digital health, that's what we look for.
Great. Can you mention one or two startups that fit that thesis?
Yeah, sure. I'll mention a couple new ones we've done recently. Stylist is a really cool e-commerce product. It's basically shopping by text. Started by a really sharp young lady named Melissa Bridgeford, who's a Harvard grad. And think about this: you take a picture of anything with your phone, you text it to Stylist, and they basically have a frictionless shopping transaction that's easier than Amazon. They'll find that. They send you back a picture with a price, or they send back to the price, say, here's where we found it. Hit yes, it's on its way to you. It's a really awesome product. We love Stylist. We love Melissa, so we're very excited about that. As we know, e-commerce has just gotten so accelerated by the whole COVID and people being locked up in their houses and not being able to get out. Another product we really like on the e-commerce space is Client Book. This company we backed, they basically allow brick and mortar retailers, mostly high-end luxury products. They've done very well in the jewelry industry. Again, this manages the text relationship between that retail sales clerk and the customer. So that texting, you go back, send me a picture of 5 different engagement rings, and I pick one. And that texting that goes back and forth is now all controlled by the store itself. And not people using they're still using their personal cell phone, but the software is coming from the store. The salesperson leaves, the jewelry store owns all the data. They have all the transactions. They make it again, easy to shop virtually for an industry that's been traditionally very brick and mortar. Those are two examples.
Right. So you see a lot of startups out there. What do you see as the main challenge they face in running their business these days?
Well, I think it's kind of it's two sides of the same coin. The main challenge is there's so much competition. when I started my first company in the early 80s, there were no incubators, no accelerators, no universities doing degrees in entrepreneurship. There were no rock stars like Bill Gates and Steve Jobs didn't exist yet, let alone Elon Musk and Jack Dorsey. Now it's become really hip and cool to be an entrepreneur. And in the state of Florida, I can't speak to the Texas state of Florida, we have 45 incubators and accelerators alone. So there's tremendous competition from being an entrepreneur standpoint. And so for people like me that are writing checks, I get to cherry pick the very, very best deals. So they've really got to have a solution that's special and unique in solving that problem. And they've got to have an impressive team. So that's all the challenge that, it's so competitive out there now.
And then on the other side of that table, what's the challenge you face as an investor in today's scene if you had to pick one at the top of the list?
Yeah, I mean, it's the flip side of the same coin. It's just like when I go in to buy a watch these days, and I was a triathlete and I'd wear these triathlete watches, and you go in and there'd be like 3 watches to pick from. Now you go look at triathlete watches. There's like a zillion. It's like I have to do research just figuring out what watch I'm going to buy. And that's true of everything across the board. So we have so many companies that come to us for funding. We have 50 a month coming just on our website, not to mention deals are being referred to us and everything. That's sifting through all that. Deal flow is a good thing, as I said earlier, but it makes it a lot of work on our side to try to find those gems and to really cherry pick those best companies and best teams. And it's competitive on our side. There's a lot more capital out there than there's ever been. I mean, it used to be early stage tech capital outside of Silicon Valley, New York, maybe Austin, a few places like that. We're working hard to change that here in Florida. Florida Funders is, and we're not the only ones. So there's more capital chasing these deals as well, too. So that's the other challenge we have.
Great. Well, if you had to pick 1 or 2 applications that you think are great opportunities to invest in today, what would you put at the top of the list?
I don't know if it's an application, but it's really applies to a lot of different applications. But anything involving real artificial intelligence. I think artificial intelligence is going to have a tremendous impact on so many industries and so much software that's out there. The word's overused a lot. And when a founder comes to us and says we're using AI, we really dig deep on that because there's a lot of faking it when it comes to AI. But true artificial intelligence with machine learning applied to almost anything. We're looking at a company right now that does this for legal contracts. And it makes it very easy for any corporation to turn around legal contracts, specifically customer contracts, with very little human intervention. And it gets smarter as it reads these contracts. So we're very excited about artificial intelligence. We think it's going to make a very meaningful difference across. I was in Israel 2 years ago at a tech conference, and they had MRI software that was being read by an artificial intelligence application, or MRI is being read by an artificial intelligence application. A lot of people think that AI is just going to affect things like truck drivers and jobs like that. And here it's reading MRIs, and every time it reads one, it learns more and gets smarter and smarter. And it's just going to we think there's just a lot of opportunity in the whole artificial intelligence space and can be applied to many different vertical markets, to many different industries. So we're very excited about it.
Great. Well, in the last few minutes that we have here, what else should we cover that we haven't?
Well, I would just I love to encourage people to angel invest because I think it's something that not only, and I know I'm preaching to the choir here, not only is it a lot of fun. I mean, we like to say we get to go to work every day and work with these bright, young, talented people who are trying to change the world. What could be more fun than that? Not only is it a lot of fun, but it's really rewarding, especially when you get involved as we do. We don't just write checks, but we mentor and coach the founders, and we try to help them be successful and increase their probability or their chances of creating the next unicorn. So I would encourage your listeners, I would just say, hey, if you're not angel investing, try it. And it doesn't need to be a large portion of your asset allocation model. It shouldn't be a large portion, less than 5%. But if you do it right, and there's a lot of data on this, you can Google and research it yourself, is it can outperform really almost every other asset class.
That's great. Well, so how best for listeners to get back in touch with you?
The best way to reach me is just tom@floridafunders.com. If you want to learn more about Florida Funders and what we do, and we do invest in companies outside of Florida. We'd like to keep at least 50% of the companies we invest in are based in Florida. We're very active in the Southeast as well. So just go to our website, floridafunders.com, and we have a portal out there, and we have companies out there all the time for investment. And we also have a place if you're a founder or an entrepreneur, you're looking for funding, we have a way for you to apply online and get into our process. And who knows, maybe it will be your next capital raise.
Great. Thank you for taking time to join us today and hope to have you back for a follow-up soon.
Great. Well, thanks, Hall. Really appreciate it. All the best to you and all the best to your listeners.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Hall T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinions of Investor Connect. This podcast is for informational purposes only and should not be relied upon for the basis of investment decisions.